Good day, friends. In the area of personal financial planning, we are discussing a lecture series on retirement planning. In my previous lecture on retirement planning, when I concluded that lecture, at that point of time I was talking about National Pension System. So, National Pension System is a scheme in which the employee and the employer contributes for the retirement benefits of the, or I would say for the pension of the employees. Even an individual who is a citizen of this country can open this account under this NPS system, and each individual who opt under this scheme is being allotted a number which is called PRAN, right? Pension retirement, which is known as pension retirement PRAN number. So, PRAN number remains unique number for each individual, and it is portable. Any part of the country you go, the number will remain same. Even if you change your company, you change your organization where you are working, right? Your contribution will be shifted to the other company, right? So, it is portable, it is very simple, it is well regulated by the Pension Fund Regulatory Development Authority of this country, and it is being managed by the Pension Trust. There are certain tax benefits if you open an account under the NPS. There are tax benefits which individuals enjoys. So, I am talking of that. So, tax benefits under Tier 1, under NPS there are two schemes called Tier 1 scheme and Tier 2 schemes, right. So, in the Tier 1 scheme, the withdrawal is restricted. After the age, a particular age only, you are allowed to withdraw, and you get the pension from Tier 1 account, but you can also open a Tier 2 account. In the Tier 2 account, you can deposit the money with a minimum subscription of 250 rupees, and you can withdraw it even as and when the money is being required. But Tier 2 account you are entitled to open only once you have Tier 1 account. So, there are certain tax benefits under Tier 1 investments. So, up to 25% of the Tier 1 contribution withdrawn by a subscriber are exempt from tax. Once a person attains the age of 60 years and he wants to withdraw 25% of the contribution, so 25% of the contribution that is withdrawn by a subscription, it will not be taxable. Means the money which you withdraw up to the extent of, supposing a person has 10 lakh rupees at the age of 60 in the Tier 1 account, right. So, that person can withdraw 5.5 lakh rupees, which will not be taxable. Annuity purchased from National Pension Scheme corpus is tax exempt. That is, if you purchase annuity, if I withdraw some money, say 4 lakh, 5 lakh rupees, and I purchase some annuity, right, under the National Pension Scheme, so that I can get a regular monthly pension out of it. So, then this purchase is tax exempt. The money that I have invested in that National Pension Scheme annuity, that will be exempt from tax. However, income generated from such annuity is following years is taxable. So, then after that period, once the interest income is being received by the individual, that interest income will be taxable. That is, the money that is being invested, annuity purchased from National Pension Scheme corpus is tax exempt, but the income generated from that will be taxable. Lump sum withdrawal of up to 40% of the NPS corpus after a subscriber turns 60% is exempt from tax. Thus, after 60 years of age, if the total corpus created through National Pension System amounts to 20 lakh rupees, a lump sum withdrawal of 40%, that is 8 lakh rupees, will not attract any tax, right. So, you keep on depositing the money at the time of retirement at the age of 60. If you withdraw up to 40% of the money, it will be tax exempt. Further, if one utilizes the remaining 60% of funds for annuity purchase, the entire corpus will be tax free, right. So, as I discussed this point earlier also, that if the annuity purchase, it is being tax free, especially if you attain the age of 60 years, but the income that is being generated from that money, that will be taxable. Here, with the help of a basically table, I am showing what are the tax implications of this under the national pension system. So, income tax benefits for national pension scheme investment are available under the following section. See, mandatory deduction from salary for retirement savings up to 1.5 lakh rupees, right, under section 80C, CD1, right. So, if you contribute up to 1.5 lakh rupees, so like say for example, even a government employee, all those employees who joined the organization central government after 2004, that is 2004 and onwards, they are not entitled for old pension scheme. They are entitled for new pension scheme which is managed by national pension scheme, right, or national pension system. Under this scheme, employer and employee both contribute. Each employee have to contribute 10% of the salary, and the employer has to contribute, I am talking of the central government, employer has to contribute 14% of the basic salary, right. So, this mandatory deduction from salary for retirement savings, the contribution that is being made by the employee up to 1.5 lakh rupees, it is allowed as a deduction under section 80C. Voluntary deduction from salary put in NPS by employer. So, employer, the amount that is contributed by the employer up to the 10% of the basic salary, right, then under section CCD2, that is tax exempted, right, that is tax deductible, rather I would say. Tax deductible means it will be, this amount will be reduced from the total income and the remaining income will be considered as taxable income. If an employee has 10 lakh rupees yearly salary, right, and 10% of the basic is being contributed by the employee in this, so this taxable salary will get reduced by this amount. Voluntary contribution by individual in NPS up to 50,000 rupees, right. So, in addition to above, that is employer contribution, employee contribution, 50,000 more I am depositing under the national pension system, then under section 80CCD1B, this amount is deductible from your total income for calculating taxable income. So, this is a great tax relief, I can say. So, once an employee open an account with the NPS, there is a tax benefit of it. Because whenever we talk of the investments, we talk of the planning, we must take into account what is the post-tax yield, post-tax return on our investment, right? And what will be the net income that we'll be getting after getting the tax exemption or tax deduction, right? So, this was about, friends, about national pension system or national pension scheme, right? So, now I'll be talking of some other areas which the individual must take into account for the better future, for I would say better retirement planning, or for the, especially for the old age, because when we feel that when we are young, nothing is going to happen, but life is very uncertain, right? So, we must plan our future accordingly, so that in case of any exigency that happens, we are prepared for all the adverse situation that may arise after us, after an individual, right? So, I mean, there is one aspect which is not very popular in India, but which is becoming popular nowadays, but it is quite popular in foreign countries, is called reverse mortgage. Reverse mortgage means, I mean, just let me tell you broad outlines of it, then I will be talking in detail about the scheme. A person after a particular age or at any age, the person is not in the earning member of the family, right? He or she is not earning, and that individual needs money. So, the banks have provided the facility of reverse mortgage. That is, supposing I have a house, I get retired in the age of 60 years, I have no pension, no income, I have no monthly inflows of my income, but for my day-to-day living, I need money, right? So, I am short of money, some ailment may take place at home, to the spouse or any individual, whatever the reasons may be, I need money. So, what I can do is, I get my house mortgaged, right, and then I get money out of it. That is called reverse mortgage. So reverse mortgage loan provides an additional source of income for senior citizens of India who have a self-acquired or self-occupied home in India. This product is beneficial for senior citizens who do not have adequate income to support themselves. The bank makes payment to the borrower. Borrower means individual who get the house mortgaged, right? The bank makes payment to the borrower in case of living spouse against mortgage his or her property, house property. Borrower is not expected to service the loan during his lifetime. Instead, the entire loan balance up to a limit becomes due and payable when the borrower dies, moves out permanently or sells the house. Suppose at the age of 60 years, you get your house mortgage for say 1 crore rupees, right? So bank is not going to give you 1 crore rupees outrightly. Bank will say, okay, we'll for 10 years or 15 years, we'll keep on paying this much money on a monthly or a quarterly, whatever you desire for it, right? And bank will keep on paying the money to you for the 15 years, right? So if the person dies, means up to the limit, because we become due and payable when the borrower dies or moves out permanently, or you sell the home. Suppose after 5 years you decide to sell your house. So whatever the money the bank has paid to you plus interest thereon, bank will charge from you. It will if you pay back that money, or if you want to dispose of that house, suppose you dispose at the point of time at 1.25 crore rupees. The house value of the house is 1.25 crore. After 5 years, you dispose it off for means with the permission of the bank. Then whatever the money that has been paid by the bank during these 5 years plus interest thereon, bank will deduct that, and remaining money will give back to you. So suppose bank with interest has paid up to 60 lakh rupees to you, right? So remaining 40 plus 25, 65 lakh rupees will be given to you, right? So you can dispose of this house. So what are the features of this reverse mortgage scheme? Low interest rates, low processing fees. Bank doesn't charge any processing fees, or very low processing fees is being charged. No hidden charges, no prepayment penalty. That is, if you want to make, suppose you have decided that for 15 years the monthly installment will be paid to you, right? Monthly money will be paid to you. Sum of money you fix up that this much money should be paid to me as per the valuation of the house, right? For 15 years. But after 5 years you want to dispose of the house and you want to pay back the money to the bank which have taken, plus the remaining portion of the house value will be paid to you, right? So if you make prepayment, there is no penalty or such, right? Or if your son, your daughter want that, okay, no more the mortgage is required, they say, okay, we are ready to pay the bank money, let the children pay the money and get the house or the property free from the mortgage, right? This is prepayment is allowed under this. So who is eligible for reverse mortgage? Only the resident individuals are allowed. Must be of 60 years when single borrower. In case of joint borrowers, spouse age should be more than 58 years, right? If the individual should be of 60 years and the spouse age should be 58 years or more. Loan tenure, it is normally 10 to 15 years, depending on the age of the borrower. Friends, we have written SBI, means this is the figure, this is the normally data which we have taken from the SBI. Different banks have different conditions for it. This is normally that is 10 to 15 years, right? Depend on the age of the person. Loan amount, minimum 3 lakh and maximum 1 crore rupees. It is from the SBI. So what you have to do is, you have to submit the documents and the papers to the bank. I'm quickly telling you all this. You have to apply under the application, which is known as loan application, completed loan application from duly filled and affixed with 3 passport size photographs. Proof of identity, means your identity should be proved either through PAN number, through your passport, driving license, voter ID card, right? So proof of residential card can be telephone bill, electricity bill, water bill, piped gas bill, copy of the passport, driving license, Aadhaar card, right? And then you have to submit the property papers with the bank. So permission for construction, if it is applicable, registered agreement for sale, only for Maharashtra, or allotment letter, stamped agreement for sale, means all the, I would say in one line, all the documents pertaining to the property which testifies that the property belongs to the person who is getting the house under the reverse mortgage, right? So when you are getting your house or the property for reverse mortgage, you must submit property related papers, occupancy certificate. Normally in case of flats, the society flats, when the society allots you the flat, they issue a certificate which is known as occupancy certificate, right? So ready to move property, share certificate, maintenance bill, electricity bill, property tax receipts, approved plan, payment receipts of the bank account, statement showing all the payments made to the builder or the seller. What it means is that all these documents are required which testifies that the property belongs to the person, right, who is getting the house under reverse mortgage. And then you are also required to give the account statement, last 6 months bank account, statement of all bank accounts held by the applicant. If you have more than one account, so statement of all the accounts. If any previous loan from other banks, lenders, then loan account statement of the last 1 year. Means sometimes people have taken loan from different places. So the loan statement of 1 year has to be given, right? So if the person is having some income, salary slip or salary certificate of the last 3 months, right? Copy of Form 16 for the last 2 years. Form 16 shows, it is related to the income tax, right? So copy of Form 16 of the last two years, copy of ITR returns for the last 2 financial year, acknowledgement by the IT income tax department. So when an employee files the tax return and the employer deducts the tax, so Form 16 shows that what is the amount of salary that is being paid to the employee and how much tax is being deducted. So your previous records are to be submitted to the bank. So business income proof for salaried employees, these certificates can be given. For non-salaried employees, the business address proof means if you are a professional, if you are a businessman, then business address proof, IT returns for the last, IT means income tax return of 3 years, balance sheet and profit and loss account of the 3 years, business license details or equivalent, TDS, tax deducted at source certificate, Form 16A, if applicable, means certificate of qualification for CA, doctors and other professionals. See, if you are a professional person, then your professional qualification has to be submitted, right? So how does this reverse mortgage work? Up till now what I have talked is that who is entitled for it, what are the documents that are to be submitted. But how does this work? With the reverse mortgage, instead of the homemaker making payment to the lender makes the payment to the homeowner. That is, the bank will pay the homeowner the money. The homeowner gets to choose how to receive these payments, means whether in monthly form, quarterly form, in what form you need money, right? So receive the payment and only pays interest on the proceeds received. So whatever the money that is being received, on that the interest has to be paid. Interest has to be paid upfront, means in the installment, the money itself, the interest will be included. So the interest is rolled into the loan balance so that the homeowner does not pay anything upfront. You don't have to pay 5,000, 10,000, 50,000 as an interest. It will be automatically calculated and adjusted against your property's value. So homeowner also keeps the title of the home, means the homeowner will keep the title. Over the loan's life, the homeowner's debt increases and home equity decreases. Means the more the money you take, your name will remain, your flat, your house property will remain in your own name, but your debt will increase because the bank has been paying you this much money, and your home equity means your ownership of the equity keeps on decreasing. As with the forward mortgage, the home is the collateral for a reverse mortgage. Means as we take loan against again any property. Similarly, in the reverse mortgage also, right, the home is kept as a home means the property against which you are taking reverse mortgage is being kept as a collateral. When the homeowner moves or dies, the proceeds from the home sale go to the lender to repay the reverse mortgage, principal, interest and mortgage insurance and fees, right. Means suppose anything happens to the person who has got the property reverse mortgaged, so the property can be disposed of. If nobody is ready to take that property, means the legal here, property will be disposed of, and with the disposition of money which the bank will get, whatever the bank has paid to the person plus interest thereon will be deducted and remaining money will be paid, right. So the principal money, the paid to the person, the interest portion, the insurance part, the fees, all this will be deducted and the remaining portion will be given to that individual. So any sale proceed beyond what was borrowed go to the homeowner, if still living, or the homeowner's estate. Estate means the person to whom you want to pass it on. So if the homeowner has died, in some cases the heirs may choose to pay off the mortgage so that they can keep the home, right. Suppose a person dies and the property value is say 3 crore rupees, and whatever the person has taken the money along with the interest and the processing fees and all those things, processing fees means insurance charges and all these charges. If the legal heir or if the person, to whom the property will be passed on, in case he pays the money, right, in that case, or the nominated person, in that case money will be paid by that person to the bank and bank will pass on the property to that person. So this was about reverse mortgage. Friends, another thing very important these days is, for your retirement, you must take into account, you must plan for your estate. Means whatever the movable and immovable property you may be having and you are having, that must be planned in such a manner so that passing on of the property to the next person to whom you want to transfer, or after the death of the person to whom you want to make a nominee or the legal heir, or you want to transfer. Normally in a country like India, normally we transfer it to our spouse and to our children, right. There should be a smooth transaction, a smooth transmission, a smooth transfer of the property, so that after the death of the person there are no legal litigations or there are no problems arises because of that. Otherwise, normally after the death of a person, especially those individuals who are having good amount of wealth, unnecessary disputes takes place in the family, and the transference of property is a very cumbersome process, right. So you must estate planning at the time of when you are alive. So this all comes under your retirement planning. We presume that when a person retire, that once a particular age is being attained, then the property should be transferred after the death to the legal heirs or being transferred to the persons whom you desire, right. So there should be a smooth transfer. So an estate plan is the process of planning for the orderly administration and disposition of the property after the owner dies, right. So once a person dies, there should be a smooth transfer of the property. This includes not only the transfer of property, but it includes the management of the property. So estate planning involves determining how an individual assets will be preserved, will be kept, managed and distributed after the death. It also takes into account the management of an individual's property and financial obligations in the event that they become incapacitated. Means suppose a person becomes 85, 87 years, that person is unable to handle the property himself or herself. In that case, how the property will be managed, right? How we will manage the property? When I am using the word property, it includes movable as well as non-movable properties. So it is about making plans for the transfer of estate after the death. The estate is all the property that one owns. It can include cash, clothes, jewelry, car, house, land, retirement savings account and so on. Means it includes all movable and immovable property, including jewelry, including your real estate, means the house and the whatever the property you have. It may be in form of gold, jewelry, right, cars and all those things. So estate plan can be as simple as having a will. You can simply write a will. But one thing is important, that will must be registered, right? So you must get it registered, otherwise it will be difficult to prove that it is the will that is being written by you. So estate planning simply involves writing a will, naming a beneficiary, means in the will you name it that whose name the property will be transferred, or as complicated as having several trusts for different purposes in addition to the will. Especially those people who are having lot of property, the industrialists who have thousands of crores of rupees of property. So what they do, apart from writing the will, they make various trusts for different purposes, that this much money, this much property will be transferred to this trust for this very purpose. Say for example, charitable purpose. Many rich people, what they do, they say they transfer 100 crore, 200 crore, 500 crore rupees to a trust. The trust will cater some, say, children's education, or it will take into account any social work, and some money is being transferred to a separate trust that will be used for a particular purpose. So there can be several trusts that can be made by the individuals. So what I am saying is that it can be simply you write a will where you write a nomination, you write a beneficiary that after the demise of the person in whose name the property will be transferred, or you can create various trusts for different purposes if you have, especially those people who have large property. So estate planning in India includes making a will, setting up a trust, or making a nomination, and even if life insurance. Estate planning surveys in India have gone to a new level. Video tapping of wills means when you write a will, you make a video taping of it so that nobody can say that the will was not being written willingly, right? So video taping of wills, making of trust, and even a probable will confined to a court in the new way. So online estate planning, such as making of an online will as well as transfer of digital assets and even email accounts, is an important business. So friends, in this lecture I have talked about 2-3 issues. One is, to start with, I talked about National Pension System, NPS account, right? So how it operates, what are the tax benefits under the NPS. Then we also talked about that you must have a proper state transfer system, right? That in which you make your estate planning. Estate planning is a very important and integral part these days, especially as and when people are becoming more and wealthy, right? And then you have also reverse mortgage system. Reverse mortgage system is not very popular in India up till now, but now it is getting momentum, and people especially in the old age people, they can, if they need money, they can get their house in the reverse mortgage form. So it will be very helpful for getting the money, a regular flow of income. So with these words, thank you very much for the retirement planning lecture, today's lecture. Thank you.